The following podcast was recorded on Tuesday, December 6th, 2022, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com or by emailing Gus Handler directly
Welcome
at
everyone to the latest edition of Talking Data. I'm your host,
You can
Kristen
also
Radosh
call
with
Arbor Research and Trading at
joined today by our commentator, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for your time and enjoy the podcast.
Today, Jim gives his thoughts on Wall Street's 2023 outlook. Wall Street is forecasting a recession, soaring unemployment, collapsing inflation, and the worst profit outlook in at least a generation. Jim, what are your thoughts on the outlook for 2023?
Yeah, Happy New Year to you too. I mean, it is as gloomy an outlook as Wall Street would ever have. And usually on Wall Street, you get fired if you try and say something gloomy like that, because you're supposed to be perpetual sunshine, pumping hope and higher stock prices and profits for everybody. But that's not the case this year. And I think there's a specific reason. Before I tease into that reason, let's run through a series of charts to show you kind of where we are. The first chart we look at comes from the Philadelphia Federal Reserve, which has done a quarterly survey of what they call professional forecasters, a panel of about 200, 250 forecasters. They ask a whole series of questions. One of the questions that they derive an answer from is, what is the probability that there will be a recession in the next 12 months? This question has been asked for over 50 years. And as the chart shows, this is the highest it's ever been. We've never seen this type of recession discounted. It's at 44% of those professional forecasters say we're going to have a recession in the next year. Now, yeah, that's less than 50, but notice we've never been this high before, even when we were in the middle of things like the Great Recession. If we jump to the next chart, Bloomberg has done a monthly survey of economists asking them the same question. Now, this only goes back to 2008. It did it 100% when we were in recession in 2020. But at 63%, it is now a majority are expecting a recession next year, and far and away the highest that we've seen, at least in the 10 years or so that they've done this survey. If we jump to the next chart, this shows Bloomberg also asks, not only do we see a recession, but what's your GDP forecast? So that thick black line on the chart is actual GDP, and you can see the first and second quarter were negative. They're below zero. And all those colored lines are whatever they think is the next 6 quarters for GDP each month that they ask them to update it. Now, I highlighted August, September, October, and November. And I've got 2 arrows on the chart, and they show you that in October and in November, the consensus forecast for first quarter GDP starts, of course, January 1st, 0. And second quarter GDP in November, 0. So the consensus is expecting, after we get through this fourth quarter number, which is expected to be around 2-ish% or so, an okay number, 0 and 0 is what they're really looking for the first half of next year. If we jump to the next chart, excuse me, unemployment. So the thick line is the unemployment rate, and the colored lines in the chart are from May through November, the monthly forecasts of unemployment. They ask, what do you think the unemployment rate will be for the next 6 quarters? The median of about 70 economists that asked that question. Noticed in May, the orange line on the bottom, they thought that the end of next year, the unemployment rate would be 3.6%. That's gotten all the way up to 4.5% by November. Each month, they keep ratcheting their forecast of unemployment higher and higher, or the economy getting worse and worse. If we jump to the next chart, that is the same chart that we saw before. It goes back to when they started asking this question in 2008, and you'll notice that the thick black line, which is the actual unemployment rate, is usually below all of the forecasts, meaning that Wall Street projects that the unemployment rate will go down, but it usually falls faster. So them projecting it will go up. The only other time they've done this, now, of course, we don't have a whole lot of history, was during the Great Recession. That was the worst recession since the Great Depression. Well, yeah, I can understand why they thought unemployment would go up then. They think that now. That's how unusual it is for them to be forecasting high unemployment. Now, the next chart comes from the former Fed economist Claudia Sahm, the Sahm rule. She has noted that when the unemployment rate on a 3-month average rises 0.5%, now to put that in today's terms, The 3-month average has bottomed at 3.7%. So if it was to rise to 4.3 on a 3-month average basis or higher, that has predicted 12 of the last 12 recessions going back the last 75 years. And maybe predicted is the wrong word. It has told you you're in a recession. And as the table on the chart shows you, the average when you hit that Sahm rule is 4 months after the recession starts. That's useful because a recession is whatever the National Bureau of Economic Research says the recession. It's a panel of economists that arbitrate this and date recessions. They usually take a year to year and a half after a recession starts to tell you that we have one. The Sahm rule on average will tell you 4 months after it started that we've had one. So if those unemployment forecasts of 4.5% by the end of next year are correct, we'll trigger the Sahm rule, and that will tell us whenever we trigger the Sahm rule, on average, we're in the 4th month of the recession. Now, we haven't triggered it yet. In fact, we haven't even seen much at all in a rise in the unemployment rate. But what's also interesting is we go to the next chart. So the next chart is the same one as before, but now the orange line added is the actual monthly rise in the unemployment rate, and I added that to the table. So I'll bottom line it for you. If the Sahm rule is triggered, the 3-month average of unemployment rises 0.5%, tells you you're in the 4th month on average of a recession. The average unemployment rate goes up after that is 3.5% if you take out the 2020 COVID spike, or 4% with the 2024 COVID spike. In other words, if we get to 4.3% on the unemployment rate on a 3-month average, expect it to go to 6.5%. In other words, there is no such thing as a soft landing. It means that, we're gonna crash the airplane if we get to 4.3%. That's what this rule says. The unemployment rate goes up a little, 0.5% on a 3-month basis, it winds up going up a lot. That has been the history of it. So we've got so far everybody forecasting a recession, everybody forecasting a big rise in unemployment. If we jump to the next set of charts here, the next chart on the list is Wall Street's forecast. These are Wall Street strategists. What do they see the S&P ending 2023 at? They are showing for the first time ever a decline in the stock market in 2023. Now, that might be a little bit off because the stock market has declined 3% in the last couple of days, so it's more like unchanged. But when they asked them, at the point that they asked them, they were projecting a decline. Bloomberg started this survey in 1999. They've never projected a decline in the stock market. Not in 01 when we had 9/11, not in 2000 when we had the tech wreck, not in 2008 when the world was coming apart because of the financial crisis. Wall Street comfortably would tell you, don't worry, next year will be better. This year, they're telling you that next year will be worse. It will continue to fall. And the next chart here shows us the dispersion. The spread between the highest and lowest strategists is 30%. So they're all over the lot. So we have got a tremendous amount of gloom and doom on Wall Street. Recession, high unemployment, a falling stock market, wide disagreement about what the stock market should show next year. If we jump to the next chart, what this shows is earnings. So this goes back 30 years, and the blue line is the forward earnings. What is this is each of the companies, each of the analysts that analyze all the 500 companies of the S&P. This is called bottoms up. What is their median forecast for that company? Aggregate all those 500 forecasts up to the S&P. That is what we expect the S&P to do bottoms up over the next year. The orange line is the trailing 12 months. What has it done over the last year? The middle panel shows you what they expect for earnings, an increase of earnings of 6.1%. The only other time we've seen earnings fall, or an expectation of a fall, was in the middle of the COVID shutdowns in 2020. But that's nominal. The earnings numbers are before inflation. What about after inflation? That's the bottom panel. So it takes the middle panel, what do we expect earnings to be in the next year, and subtracts from it the University of Michigan 1 year forward inflation rate. Since I'm looking at what do we expect inflation to be in the earnings to be in the next year, I'm comparing it to what we expect inflation to be in the next year, according to the University of Michigan survey of what do we expect the inflation rate to be in 1 year. That number shows that expectations of earnings is 1%. Now, the only time it's been worse than that was the COVID shutdown of 2020. In the last 30 years, there's been no worse expectation on earnings after inflation than we have right now. So up and down the line, Wall Street is as pessimistic and as gloomy as you have ever seen them, whatever measure you look at. It is completely unprecedented to see this much bearishness on Wall Street.
How are market players viewing it?
So let's go to the final image that I've got here for us. This comes from Kevin Poff. He's Meet Kevin. He's a 30-year-old social media influencer who's got like 1 million followers on Instagram and Twitter that pontificates about the stock market. He's a real estate broker in Southern California. He actually ran for governor in the Democrat Party. I think he got 13 votes or something like that, but he did run for governor. And he tweeted out a couple of days ago, Jerome Powell is panicking. He realizes the bond market's yield inversion is so bad based on history. We need to cut rates 500 basis points, 5% soon. That would basically mean be cutting to zero to avert a deep, dirty recession. And then he finishes, prepare for a glorious Fed U-turn and massive deflation. So what my comment to it on above was, just for those that are not watching, welcome to 2022, where the bull story is everything goes bad, the Fed cuts, and we all get rich. The market is a liquidity junkie. It needs cheap money more than it needs good earnings and growth. And let me emphasize or embellish on this. 15 years of QE, zero interest rates, negative interest rates, the Fed put forward guidance. The market has been trained. You buy broad-based ETFs and then whine to Jay Powell, make my stock portfolio go up. And for 15 years, that's what's happened. And that is what people are still accustomed to. That this liquidity that in cheap rates has dominated everything. So the market has gotten, the forecasts have gotten to the point where I know how we're going to get cheap rates in 2023. Everything goes to hell. And then the Fed U-turns, and as Kevin Paff says, prepare for a glorious Fed U-turn and massive deflation. Boy, that used to be a disaster for investors, but not in 2023. The U-turn means that markets will moon, to use a crypto term, and we're all going to become rich because the Fed U-turned. Never mind that all the companies you've invested in, because you think that they're going to be good companies and have good outlooks, what you want them to do is cut people, show losses, because that gets the U-turn. That's more important than in actually having a stable, sound economy. This is how upside down everything has gotten right now in the marketplace.
And Jim, what is the contrarian case for 2023?
So looking at this, where does this go wrong? Well, obviously it goes wrong in one of two ways. The first way it goes wrong is we don't have a recession. We don't have high unemployment. We don't have terrible earnings. We don't have a stock market that falls out of bed. Jay Powell and the Fed look at that and go, oh, that means then that the wealth-driven inflation that we have, people see their home prices, this is 2021, saw their home prices gain, saw the stock market gain. And by the way, in Jay Powell's speech last week at the Brookings Institute, he specifically mentioned that one of the drivers of inflation was you, me, and everybody else got rich because our home went up, our stock portfolio went up, and we spent money like drunken sailors, and we overbid for stuff, and that's what caused the price of it to go up. That was part of it. The supply chain problems were also part of it, but that was part of it. If we don't have a recession and we don't have bad things happen, Jay and the Fed will say, they're just going to be buying stuff and bidding up for it again, and the inflation rate's not going to go down. We have to keep raising rates. We have to keep, or if we keep raising rates, we cannot even consider cutting rates in 2023. No pivot, no U-turn, in the Fed, as Kevin Paff liked to say, and that would be considered bad news. So God forbid people get jobs or companies create profits, because that's not what we want to get higher stock prices. You tell the sarcasm in my voice. What we want is we want terrible things because we want cheap money. The other contrarian argument is the Sahm rule. If unemployment goes up a little bit and things turn down, but the momentum of an economy is when it goes bad, it goes bad. It just doesn't go a little bit bad, it goes a lot bad. Not Great Recession bad, but standard recession, 6.5% unemployment, that even cheap money won't save you from the stock market or from investments. Yeah, it helps, but things have gone so bad that it's not enough. So this whole idea that we're going to get this kind of somewhat lousy economy and the Fed will U-turn and that will lead to a boom in stock prices in the second half of 23 or maybe into 24 is what everybody's hoping for. As I said, you get fired on Wall Street for saying something pessimistic, except when the pessimistic story is everything goes bad, that gets you the glorious Fed U-turn and then everything booms on the backside of it. So the bull story for 2023, the upside down world we live in, stranger things, is everything goes bad and then Jay has to cut rates and maybe even stop QT, and that gets us a big rally in the second half of 2023. Good luck with that story. Like I said, the thing that can make it wrong is A, it doesn't happen, we don't have a recession, or B, if we do sink into recession, it gets a lot worse than people think, and cheap money alone won't save you.
Jim, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Arbor Research, Bianco Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks everyone, and have a great day.